right here on TFNN.com, live inside the eSignal platform and broadcasting on your mobile phone at TFNN.mobi. Let's check out where the markets are at right now. We got the S&P is up 10.5 points right now. We got Russell up 5. We got the NASDAQ up 32, and the Dow is up 100, hitting those triple-point swings again. Looking on over at copper. Copper right now is up a little over 0.5%. We got gold down just a little bit, just down a few points on the day at the moment. Looking on over at silver, we got silver down about 0.5%. We got oil is currently up about 8 cents. Natural gas is up a little over 1%. We got our ag markets right now. We got corn up 3.5 points. Doesn't sound like a lot, but that is a 1% move in corn. Looking on over at soybeans. Pardon me. Soybeans. Pardon me there, folks. All right, let's check out soybeans. It's up $1. We got pound dollars down 51 pips. Euro dollar is down 58. Euro pound is currently down 16. Dollar franc is up 56 pips on the day. The dollar yen is up 1. Euro yen is currently down 70 pips. The Aussie yen is up 30. Dollar index currently up about 0.5% on the day. And then looking on over at the bonds, pretty flat right now in the 30 years. All right, well, that gets you caught up with your lunchtime market wrap. And next thing we got to do is we're going to go in. We're going to, we got to, let me go over the whole schedule today for the show. The main thing that I want to cover is get you ready for the news. We're always talking about the news, always giving you the stats on the news. And, again, there's a lot of ways to use the news. But I got to remind you, okay, very important, because we are less than 24 hours, okay, from the registration deadline. So there's less than 24 hours, less than a day to register. So go ahead and hop on over right now. While you're listening, hop on over right now to TFNN.com. Click on the big virtual trading competition banner you see right here and fill in your first name, your last name, your phone number, and your email address and click submit. Okay? That will get you going. You want to do this right away. Get this done. If you're in the U.S. or Canada, make sure you do this right away, okay? And I was able to verify that we're able to use the scanner on the competition as well, so that's good news. But make sure, again, you hop in, and I called Nadex up and asked to hop in and make sure you register for that right away. And they'll go ahead, and as soon as you do that, hop back over to the homepage and make sure you register for the free trial access there to the scanner. That'll last well past the competition, and you get used to it. You're going to get access immediately to some basic education that's really going to help you out a lot when you're learning to trade on Nadex. You don't want to learn on day one of the competition. It's not that that's bad, but why wait, right? So get in there, learn some stuff now, see what you can do, okay? And you can get a free demo account. Just hop on over again to TFNN.com, click on the Nadex banner on the right side of the page. From there, what you're going to do is you're going to click on Trading Demo Trading Account. And if you're in the U.S., U.S. territories, Canada, or Mexico, you can go ahead and open your demo trading account. Fill in your username, first name, last name, phone number, and email address. Click Apply for Demo. And you'll get an email right away. You'll be able to log in. You just go over here. You'll choose Demo Account. You'll type in whatever it is you chose to be your demo username. I do recommend you make it shorter than mine because it gives it an issue on the app. But I usually log in live on my app at this point. But you can go in and you log right in. You'll have $25,000 of funny money in there that you can play with, experiment with. And that's a good starter for you to learn this week, okay? So get in there and just get familiar with it. Start hitting buttons, start making mistakes, start just getting all around. Now, if you register now, you're going to get access to a webinar that Tommy O'Brien's going to be doing as well. He's going to walk you through a lot of this and help you get a head start on it. So make sure you do go ahead and do that. Now, once you're ready, the idea is to get you in here, get you going, help you understand how it works, let you have some fun, let you make some money without any risk. And then, of course, also to, ideally open an account. So, when you're ready, hop on over to Nadex.com there from the link off TFNN and click on open an account. It literally just takes a couple minutes. Just fill in your information right here. And, now they got all the regions and everything else. Looks like they're adding a bunch of stuff, but which is good. But just fill in your information, get that done. In about 5 minutes, you can have your account open and actually potentially funded in as little as 5 minutes, okay? Sometimes it takes longer, but most of the time it's pretty fast. And that's really just your natural progression. Now, if you haven't been inside the scanner, let me show you what is in here and how this works, okay? You hop on in, and when you log in, then you'll see your login, of course. You can go to the home page over here, and there's a video title section, okay? So watch each step getting started tutorials first thing. So basically this one's just a tutorial that tells you how to get started, okay? And it tells you exactly how they work and all that fun stuff. So very, very simple. Step 2, watch tutorial trading using the help desk for any questions you have, okay? And then step 3, use the box spread scanner and now the binary scanner and use the deviation levels when you're trading futures, Forex, and Nadex. So you got your tutorials up here getting started. You got step-by-step basics. You got who is Nadex. You got the spread master series, the binary master series. You got archives of my shows right here where we go through stuff. Okay, so just get in there and knock that out so you get a lot of the basics out of the way. And then, we post the deviation levels as well. So if you go right here, you can view all of them. Okay, and we actually update them every day at 8:15. The settlement price is based on the settlement price of that market. What is the settlement price? Well, I talk about that a little bit over here on the deviation levels. Say for the CME, the market closes at 415, like the S&P. What they do is they take all the trades, the CME takes all the trades in the last 30 seconds. And they take every price that the market was traded at in the last 30 seconds. They then multiply that times the volume, the number of contracts traded at that price in the last 30 seconds, okay? So, for example, I have a 1,400 times 7,000 volume, be 9.8 million. That's the weighted value of that price because that's how many times a contract was bought or sold at that price. They add all those weighted values up, and they divide it by the total volume of all the contracts at every price that were traded. So there's 26,500 contracts traded in the last 30 seconds in this example. So 26,500 divided by 37,108,800 is 1,400.25. So that's how the CME comes up with the settlement price. That's an important number. It basically stands for the market consensus of what the S&P E-mini was worth as of 415 where everybody agreed. It's where they're going to determine expiration value for in-the-money exercise on options. It's how mark-to-market accounting is going to be done in trading accounts, hedge accounts. There's a lot of things like this where there's like a deadline, a date, like for swaps and all this other stuff that could definitely have an impact on the market. So right there, that's how settlement comes up. Well, that's the number we use. We pull that number from the CME and ICE and everybody else, and we go in, we post those prices on the deviation page. And now, okay, so we got a settlement. That number makes sense. That's easy. Where do we get this deviation? Where do all these numbers come from? Well, what they are is we go in and we pull the expected movement, which a big fancy term is implied volatility, but the expected movement that's built into the price of an option. And the example I've used 100 times before, but if you're in a car and you're driving it, or if you're going to be, let me put it a different way. If you're the insurer and you're insuring a 40-year-old female who has a perfect driving record compared to a 16-year-old that just started driving or maybe had a wreck or two. Let's put it like they've already had one wreck and they're on their second car or something. Who are you going to charge more insurance to? Who do you think has more possibility of being a little more volatile, moving a little bit more than they should maybe on the road? Obviously, the 16-year-old that has the wreck. So especially if it's, a boy, right? Because we're nuts when we, are 16, we get our first car and everything else. So they pay more in premium. That's an expected movement. Like how much risk is involved in insuring this person. Well, that's actually in an option price. So, for example, let me show you something I haven't done too many times before, but I'll show you this. We'll go in and we'll look up. Let's see if I have anything on the Analyze tab over here. Okay, yeah, let me get rid of all these. And we're going to go in and sort of show you a way that this is expected to play out. We'll go in, we'll look at the Analyze, and maybe we'll actually go, I'm trying to figure out the best tool for displaying this. I don't want to go there yet. This is Thinkorswim. Has a lot of cool tools on it if you haven't used it before. And let's see, where do they add the back? Okay, simulated trades. That's just going to be the analyzer. They have the one of the items they used to have on here. I'm just trying to figure out where it is now because they are always changing things around because they keep adding more and more and more cool features to it. But yeah, okay, I'll just show it to you on a normal one. But if we go into Apple, okay, and we're looking at it over here. Let me shrink this side if it'll let me. Let's see, bring that in, that in, that in. Yeah, that ain't helping any. Okay, but I want to bring everything over to analyze, so I don't want to get rid of it all yet. And so we go down and we go, okay, let's look at, we got, 9 days until this contract expires. So let's look at a straddle. Okay? Actually, let's look at a strangle. That's even better. It's going to be the exact, no, we're going to do a straddle. We want the same strike. So, where did that go? I just had it. All right, straddle. And let's just say we're going to buy a straddle. Okay? And then I'm going to go in, I'm going to analyze this. So let's do analyze duplicate trade. No, we don't need that. I need to see the risk profile. There we go. That's what I was wanting. Okay. And that's looking at the market being basically right where it is. Just want to double check. That's where we are. We're right at 101. 102 really actually would be a better one. So let's delete those off. Let's do 102 because the market's at 101.96. Okay, that's a little bit better. We go into the risk profile. And we'll add these on. I may have to do this when we come back just so I can pull it up for you. But let me move this over. Pull it out. And then we'll go into probability. There we go, probability analysis, and then we'll go into think back. Think back is what I was looking for. They just moved the tab. So we come back. I'll do it one more time. I'm going to do it looking backwards to show you how accurate this is. Okay? Sorry it took me a second there. It's been a little bit since I've used it for this function, but we'll do it right when we get back. Stay there. Trading out. All right. So what I got up here is I have the Thinkorswim Analyze tab. Let me pull that out, and if it'll work for me for its own window here. And we can pull up Apple, Google, whatever. I was just running through multiple scenarios. The closer you get to expiration, the more accurate it will be. Okay? But here's the idea. We go back, and let's say we go back to the, let's see, today's the 24th. We go back to the 15th. Okay? And so we're going to look for trades that expire. Let's see. Trying to find, we got the 14th ones. Let's go back one more week on it. So we'll go like one more week here. We'll go to the 8th. Okay, so now we have September 14th contracts that are coming up. And what we do is we go and we look at that contract, okay? And then we look for a straddle. So now this is really making it a lot simpler than it is, but I'm just trying to show you the concept, the idea. And when we do that, we go in and go, okay, well, what if we bought that straddle? Well, that straddle basically costs $4. At $98, that means the expectation is by, if we go down to the expiration date here, we'll go to the, basically the 14th. What would be, the net yield on the trade? Would it be good? Would it be bad? And so we got to go, let's go into the actual expiration date and go, where were we at? What was the high? And this is the important number. What was the high? Because you don't want to hold an option to expiration. I don't care if you're doing binaries, spreads, whatever. So I've seen some really good studies on improving how bad of an idea that is. I've done a few myself. So if we go in, and 98.36 is where the market's trading. We bought a $98 straddle for $4.24. That basically is saying the expected move, okay, is 102.60. Now, it may go more than the expected move, especially when you have, certain big news events coming out, like we're launching a new iPhone or whatever, okay? But the expected move was 102.60. And then we go, okay, well, what was, if we go at, another expected move, that'd be basically another $4. And this is just a very simple way to try to say what they're trying to do is price a straddle. A fairly priced straddle is what's the expected move should the market go up or down to where you'd be break even on the trade. Okay? If it hit that expected move. So if it moved up $4, and 20 cents, you should be about break even on the trade. And that's really how far it's expected to move. It's not expected to move $8, $9, $10. So in this case, we're looking at getting in on September, 8th, we said? Okay, so right over here. And when there's high IV because of, events coming out, but we'll go here. Let's just look at it. September 8th, so we got $98.36. Expected move is it will go up to 102.60, I believe is what we said. So now we just move it on up. Let's go. How high did we go? And we got a high of 103.05 between the release and the expiration of the option. So pretty on target. So, I mean, just, like right there, you got the high of this day's 102.20. And then, of course, when it rolls over to it's expired because when it rolls over, but when it rolls on over, then you got 102.81 as a high. But so right there within just a few cents. We can go back. We can do the same thing on, let's do Google. Okay? And again, if you would have held it, it would have came back. You would have lost everything. That's why you don't hold when you're doing this. All right, so let's go back. Let's find, okay, so we got the 8th. We got 4 days left. We do a straddle. The market's at 589. See how close we get. We got 590. That's pretty close. Okay. So we got a straddle right there. $8. $8 plus 589. So just pull out your handy calculator. So 589.72 plus $8.10. 597.82. Again, this is a very crude method, but it does show that there is an actual rationale in the options. So either up to 597. Well, it didn't go up, so let's go ahead and just ignore that. And now let's go ahead and take, let's go the other way because we know it went down. And let's look at 589.72 minus $8.10. Down to 581.62. So that's basically the one deviation expected move built into the price of the straddle. How low did it go? And so if we track it, we got some pretty low numbers right there. We got 580. It busted through down to 76, but it pulled back up, closed at 583. Right here, we got it busted down, closed up at 581.35. And on the final day, it actually pushed right through it. It had a high of 581.64, but it ran on down a little bit more on the 12th down to 574. But for most of the days, we were right to that expectation. That 581 would have been that safe place where you would have wanted to take that profit, and probably would have been one of the wisest places. So anyway, stay right there. We'll be back after this break. I just want to really drill home this point of expected movement being built into options, and that's making it easier. Stay right there. All right, so just showing you an example. What we're doing is we're going through and talking about how options basically are the poll of all traders, where they're putting their money where their mouth is on their vote and how far they expect the market to move. And this gives you a very realistic expectation. Most of the time, the market actually will move a deviation or more, okay? But you don't want to have this, dream that it's going to go forever. You want to know, where do I need to take profit on this thing? You need to know, at a certain point, I may risk giving it all back. Like that, this Google trade, you would have made a little bit more if you held. Not that much more, but a little bit more. On the Apple trade, you would have gave it all back if you held, okay? So it's really important that you have proper expectations. I don't care if you're trading stocks or futures or Forex or CFDs or forwards or spreads on Nadex or binaries on Nadex or whatever it is you're trading. You need proper expectations of how long it's going to take for a market to move a certain distance. Options help you do that, even if you don't trade options, okay? All the more important if you do trade options because of the time value that can really, knock you upside the head. And so you see, okay, it moved down to 581.62 as expected. It comes on down there. And so, we can go over here and we can walk through and see what would have happened on this trade. I mean, it had a massive move right there at first. And that seems a little odd, but then it keeps going. I think that was a misprint. But keeps going, and, basically at 12,560 was the max profit on that trade. Not a bad trade. And so you can go back and you can look at, different prints on it and see how it moves. But that's really important that you understand that movement. We do the same thing on Microsoft. You can pull up anything that has options on it, okay? Exchange-based options, really. You don't want to get OTC options if you can avoid it. So here's September 8th on Microsoft. We got 72 cents as an expected movement there, okay? 46.40, that's between the 8th and the expiration, which is going to be on the 14th. So if we go in, let's pull up a handy little calculator, and I can do all this in my head, but why waste the brain power when you can use it on other things? We'll go on over here. We can, let's see, Microsoft went up, obviously, so we can go ahead and add 70 cents. The expectation is it'll move basically to 47.17 by expiration. We go in, we zoom in on this trade, specifically on where it was going to expire out at. So we got in on the 8th, okay? And we said it would go up to, let me bring that back up, 47.17, okay, is the target price between the 8th on the upside, on the 8th and the 14th. So 8th, we got 46.97, 46.94, 47. So we're 17 cents away, and then it actually comes on back down. Okay, and this is why we often take profits, but we're 17 cents away from taking our profit. That was the proper expectation. Expecting it to go a whole lot more than that was not a realistic expectation. So it'll get close. Sometimes it'll blow through it, but it'll be right around, and the majority of the time, 70% or more of the time, it'll be right around that. Every once in a while, I'd say like 5 or 10% of the time, it'll be under it. Most of the time, it'll be over it if it goes to it, okay? But if it, for that other 30% of the time. So like 25% of the time over it, 5% of the time under it. But it all depends on the market, what you're looking at, everything else. There's a lot of little variables. But the bottom line is the majority of the time, and that's what trading's about. It's about probabilities, okay? The majority of the time, that's really as far as you should expect the market to move. By knowing that, you can save yourself a lot of trouble. So as the market moves forward, we watch the P&L, and do we hold it all the way through? No, we got really close. Now, this is not including the highs. This is including the close. But, I mean, was there enough room in the expectations to make money? And what I look for is if there's enough room in the expectation to actually make a nice profit, okay? Now, we take all that information. Now, this is on like 4 days or 18 days or 30 days. Or, and the further out you go, the less accurate it gets. Because, it's easier to predict what's going to happen in the next 5 minutes, 5 hours, 5 days than it is in the next 5 months. As far as this price action is concerned, at least in my humble opinion, okay? So I can tell you target prices over long periods of time. But as far as, up or down and all that stuff and distance, it becomes a lot easier to do the shorter time frame. So what I do is I take the same formula that's being used to price the options, and I turn it inside out. I grab that implied volatility out. I grab a deviation move out, and I turn it into a 1-day move. And that gives me daily deviations. Like instead of saying, we said like 70 cents on Microsoft. I'm saying, okay, $18 on S&P today is the expected move. Doesn't mean it's going to move that far, but that is the expected move built into the price of the options. There's been a lot of volatility lately, okay? And that's high to low, and that's really important to remember. This is a high to low. Sometimes it'll go down 9 and then up 18, and, on around the list. We got $14, and you can sort of see, the different markets that we're listing here. We got the small cap. We got U.S. Tech. We got Wall Street, oil, natural gas, copper, gold, silver, corn, soybeans. We got, a variety of FX pairs, so like 18 FX pairs or more. I got, ES, NQ, TF, YM, CL, GC, HG, SI, ZC, ZS, 6A, B, C, E, J, and S. So we have a variety of markets you can use this on, futures or Forex traders. By having this, it'll help you out just a ton in knowing what your proper expectation should be for if it moves this far. Let's see here. Let me pull up something right here. It's having a little bit of a hard time, but I'll just go through and open the chart up for you. Here we go. And we'll go through. We'll look at some of these. So we got oil right now. It's pushed up to 90% of its deviation level between the high to the low. Okay, see how it ran up to 0.5, it pulled on back down. We go over, we can look at, and expect after yesterday we'll have a little bit lighter moves, but just looking at everything and seeing what those deviations are. If we go back day after day after day, you see that they hit them a majority of the time. But let's load up oil. Let's check that out. And let's look here. So we got this is moving on up. It's about 85% right now of the expected move on the S&P. It's basically saying that if there's an expectation that 30% of the time it will not surpass, in this case, 1991 probably, and we went down a little bit under 1972. We went down to 1970.5, so you got to subtract a couple points off that. Basically, we're looking at 1989 as the high to low target on ES. Okay? And that's if we hit a full deviation today. We can go in, we can look at all the markets one at a time, and you can see day after day how they do it. We can go backwards. There's yesterday out of ESC, it came right down to a 1 deviation move. And day before we can look at it, came right down to 1 deviation move and just went flat. And so we can do this again and again and again and to see, did it help us hit the proper expectations? This one, it went up and then came back down the high to low, which is what I'm measuring down here. The high to low, we hit a 1 deviation move again the day before that. We go the day before that. We look at it. It went right up to, right at the end there, right up to a 1 deviation move. So again and again, we're seeing that it's hitting a 1 deviation move within basically a 24-hour period. I'm using the settlement price, but I'm using the IV from 8:15. So basically what I do is I let the market close, I let the market open, I let the options trade a little bit to get some, liquidity back in the market, and then at 8:15 at night, I pull the implied volatility out and post the levels up. So having expected movements lets you know, again, don't add into positions normally whenever you're getting to a 1 deviation move, high to low, or 1 deviation above settlement, 1 deviation below settlement. Tighten your stops if you're already in. Potentially look for, I'm not saying take, but look for a reversal trade. Get some sort of reversal signal before you just take it, because every once in a while it'll just blow through those deviation levels. And that's why we have 2 and 3 deviations plotted also for that, remaining 30%. But most of the time we expect it to go to a deviation. And it's not a pivot point. It's not a fib level. It's not based on any past market price action. The closest market price action you could say would be settlement. Okay? And really it's not even based on settlement because we're counting a deviation from high to low regardless of settlement. So if it moves 18 points from the low to the high, it moved the deviation move. Okay? No matter where settlement was in that mix. So we're really not in any way using historical pricing, historical volume, historical anything. We're using live, current, implied volatility of where market participants say the market's going to go next over the next 24-hour period from 8 p.m. to 8 p.m., and that is the number that matters for determining that expected movement. And most traders, they have technical analysis, and some of them have fundamental analysis. We talk about the news a lot in here. That's the fundamentals, right? But the biggest piece that they're usually missing, we talk about technicals, we talk about fundamentals. Some traders have seasonal analysis, which is a little more challenging but very powerful, as long as the government's not messing up all the seasonalities. But the one thing I rarely see a trader have is the statistical analysis. And those are the 4 pieces of diagnostic trading. Fundamental analysis, which is government news, news reports, etc. Seasonal analysis, which is cycles. And you'll see me every once in a while pull up seasonalities on the VIX and things like that. And then again, technical analysis, volume, price action, indicators, etc., anything on a chart. And then the last piece being statistical analysis. But often when I see it, I'll see historical statistics like what you call standard deviation, the bell curve. That's past. That doesn't tell me anything about the future. Think about every disclaimer you ever read. Past performance is not indicative of future performance. Okay? So looking at the past doesn't really help you in the future. I want to know, what does everybody who has money on the line right now think about how far the market's going to go? Because you don't really want to fight the market. Okay? Doesn't mean I'm not contrarian to price action or whatever, but I'm talking about as far as algorithms are using this. The big algos, the big funds, you think they don't know the statistics on how far a market will move? You think that maybe is why when we hit a deviation we see a big volume spike and they're dumping off shares? Okay? So very, very important levels and will really help you in your trade. It gives you a true perspective on how far has the market moved, can it keep going, or is it done? And then along the way, what I have found is that the deviation levels themselves serve usually, honestly, as great support and resistance levels. So a lot of times we'll see a bounce between those levels as well. I used to just plot 1 deviation, and I expanded it out to 2 and 3 for those days that it does go further. And I barely ever have seen it pass a 3. And that's really a one-off event. I think I've maybe seen it 2 or 3 times in the past couple of years. And then, the last piece is, just using those as areas to trail your stops. And one thing, a system I've taught before was the 10-minute, trading method. I went in, basically it's just really simple, but it's using 10 minutes to determine direction. I use 10 minutes with deviation levels. And I'll go in, and I'll wait for it to close above, and hit a price. So it closes above, it hits a stop here. Okay, we're going long. When I see the market close above a deviation level again, I'm going to trail touch a deviation level. I'm going to trail my stop at 5 ticks below the low of the bar. Touches another deviation, I'll trail it again. So, and you can see that, I could have had a nice trade basically going from here all the way to here just on using 10-minute bars on deviation levels. I can add in things like MVP to help out with that. I can add in things like expected volume to help out with that. But ultimately, I can just look at price action with deviation levels on them, and I can trade just that. So it's just one more play in the playbook. It's also a good way to look at the market. Again, if you see the market closing higher than a deviation level, then that usually is the direction you're going, okay? Trailing your stop 5 ticks behind that bar. Every time it touches another deviation level or zone there, trail it 5 more ticks. If it closes below and above a level again, then you can trail it again. But basically just trailing it at each deviation move. And whether it be a 0.5, a 0.7, a 1, a 1.5, whatever. And it can sort of give you a trend view of the market in and of itself. So that's probably one of the simplest methods for day trading that I can give you right there. And let's see, I can add on something like an MVP with it if I want to, add on like some sort of indicator, give confirmation. But really not even needed on this simple system. So, but it's just, it's combining a couple things together. Let's see here. All right, we got it. And okay, so this actually would have got us in sooner than MVP. Right there, would have got us in as soon as it broke the high of this. Would have went long, and then we could be trailing. You could trail with the MVP line. You could trail with the predictor there. It's a little bit closer. MVP being momentum volatility predictor. So that's momentum line, and it's basically a volatile line with a predictor arrow. So it's sort of a modified SAR. And something you can use as a trailing stop, or you could have got out as soon as it touched up here. So if you're like, you know what, I think there's still some room to go up to 1 deviation, you might just go ahead and follow the predictor and see if you can, squeeze a bit more out of it. And that's your choice if you want to risk, giving back 4 or 5 more points or not. So, but I'm just using that 10-minute direction with the expected movements, and we'll see, major turns and oscillations at those movements. It's also a great scalping area. You'll notice 0.5, 0.7. See how it's just bouncing in between there? You could be scalping in and out of S&P like for a huge chunk of the time. You can throw on some spreads to hedge your scalps and just start scalping over and over and over again. Lots of cool ways to trade, combining futures and Nadex. That's actually my favorite way to trade. But anyway, so stay right there. We'll be back right after this break. So welcome back here to the Diagnostic Trading Hour. We've just been going over how to basically know how far any market will move over any time frame and how we help you out with that on a one-day move and using forward expectations of market participants, not backwards actions of previous order flow. Let's see here, going in and looking at maybe a couple more things. But that's pretty much the main things I want to go into with you today. The other things I want to go over with you is just to make sure you're caught up or any news that you need to have on your list. And so let's look at that real quick. Let me pull it up. We'll throw up, Forex Factory. That's just one of many easy sites to look at. We had the new home sales this morning. But also, what else do we got going on for the rest of the day? Or tomorrow. Okay, so we got tomorrow we're going to have a variety of U.S. releases coming out. Looking at an 8 a.m. entry for a 10 a.m. expiration for a $25 minimum profit on an iron condor. This is based on the euro dollar, and it's based on the core durable good orders and durable good orders. And let's see, so that will come out. We'll also have unemployment claims come out, which means make sure you're watching out for Spike Striker. As well as volume spikes that happen, maybe give you some reversal trades. We got weekly natural gas inventory coming out. So also we can look at some volume spike tracker reversal trades there, 10:30 to 11:30 when they come out. Tomorrow night, 7:30 to 8:30 Eastern Time, we're going to have Tokyo Core CPI, National CPI happening at 7:30. That can definitely have an impact on the yen and maybe a little bit on the Aussie as well. But just be very aware of that event. Tonight, if you're trading the Aussie, we got the RBA governor talking at 10:30. Governor Stevens is going to be talking. And might be some volume spikes that occur when that comes on out. Those are going to be your main trades We had oil inventory. We can go in and we can look at that real quick. Let me pull it up. I think we had an oil chart earlier. Let me pull up the oil trade, see how that came on out, and get that done. When that loads on up, we'll walk through that trade and see if there's anything else. But that really is going to be the main trades on the week. All right, so going over, and let me throw on the spikes here. There we go. All right, I want to add one more thing so I have that volume spike analysis built in. And with that loaded, eventually, as it comes up. All right, so we did have some volume spikes to go short. We did get a short right there. You see how that triggered, flew down, and right off the expected move as well, right there, like right at the very end in the last 10 minutes, and flew on down there on both 5 and 10 minutes, both given short volumes right there, along with the MVP staying short the entire time. But market moved up, hit the expectation on the hour. Also hit the 0.5 deviation, as I mentioned earlier, that will often serve as a resistance or a support level. So it did. It popped up, hit the expectation, went a little bit further, right into the 0.5 deviation, turned right back around, right on a volume spike. You can see that volume spike really clear on the 10-minute bars, where you see the volume being twice that of the volume bars on the other side. Gives a reversal based on price action to go short. It goes short, comes on down, and closes well in the money. And so just a perfect sweet oil trade. Okay, so that's your oil inventory report. Remember, you can do the same thing tomorrow on natural gas, okay? Let me see. I don't know if I have time. If I do, I'll open it up. If not, then we'll just have to cover it next time. But let me open it up over here, and if I can get it out and get it loaded fast enough. We have, again, like I said, we have natural gas from, coming out at 10:30 tomorrow. So I just wanted to go over a little bit more, but we'll review it tomorrow with you. I hope you all have a great day and in the markets, and I will see you tomorrow here on the Diagnostic Trading Hour. Thank you.